Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, April 22nd, and we're seeing some notable shifts in markets as geopolitical tensions continue to influence trading patterns. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story continues to be the geopolitical situation and its ripple effects across markets. Iran has seized two ships in the Strait of Hormuz, even after the US extended the ceasefire, which is creating significant uncertainty. Oil traders are specifically citing Hormuz closure concerns as a major driver of market disputes and volatility. What's particularly interesting is how this is playing out across different asset classes. The EU is now proposing plans to soften potential energy price shocks from an Iran war, which shows just how seriously policymakers are taking these risks. Meanwhile, Moscow has suspended Kazakh oil flows through a key pipeline supplying Berlin, adding another layer of complexity to the energy situation. On the corporate front, we're seeing some significant leadership changes that are worth noting. Apple has named John Ternus as their new CEO, which is a hardware legend taking the helm. Though, as some analysts point out, hardware expertise alone didn't save Intel investors and won't automatically guarantee an AI win for Apple. Best Buy is also getting a new CEO with Jason Bonfig replacing Cory Barry in late October. On the positive side, Boeing actually beat estimates with improved aircraft deliveries, and the stock jumped on that news despite the company still posting narrowed losses.
That's quite a mix of developments. The geopolitical situation seems to be creating this push-pull dynamic in markets. How are you reading the market's interpretation of all this?
Markets are clearly trying to balance these competing forces. On one hand, you have oil prices climbing on supply concerns, which typically pressures equity markets. But we're also seeing what one headline called a wartime market that keeps rising, which speaks to this unusual dynamic where geopolitical uncertainty isn't necessarily tanking stocks. The dollar has actually given up the bulk of its war gains as traders abandon bullish bets, which is significant. That dollar weakness is actually supporting gold and other alternative assets. We're seeing commodity trading houses positioned perfectly for what Bloomberg called a wartime trading bonanza, as volatility creates opportunities for those firms. What's interesting from a sector perspective is that technology continues to show resilience. Palantir just inked a $300 million deal with the USDA to safeguard food supply, which shows how defense and security tech remains in demand. The mortgage market is also getting a boost as rates sink again and home buyers are jumping back in, which could support housing-related stocks.
Let's talk about the broader indices. What's your technical read on where we stand?
Looking at the major indices, we're in an interesting technical position. The S&P 100 is showing resilience despite the geopolitical noise, holding above key support levels. The index is dealing with this question of whether we're progressing toward a bubble, as some analysts suggest, particularly in certain pockets of the market. The Nasdaq continues to be driven by mega-cap tech. And there's active discussion about ranking the Magnificent Seven from most to least attractive based on future cash flow, which shows investors are getting more selective about valuations, even in big tech. The Dow has been more volatile given its exposure to industrials and energy, but futures were rising after the Mideast truce extension, showing that any positive geopolitical development gets a quick response. The key thing traders need to watch is whether this selectivity continues to spread. We're seeing questions about which private credit funds believe their own balance sheets, and there's discussion about meme stocks potentially headed for index funds, which could create some unusual dynamics.
That selectivity is going to be key. What does this environment mean for traders and investors, practically speaking?
For traders, this is an environment where you need to be very tactical and selective. The geopolitical premium in oil means energy stocks could see continued volatility, but that cuts both ways, with potential for sharp reversals if tensions ease. The dollar weakness we're seeing creates opportunities in international stocks and commodities, particularly precious metals. From a defensive standpoint, the fact that mortgage rates are falling could make home builders and related sectors interesting, especially with buyers jumping back in. On the risk side, investors need to be aware that some analysts are pointing out the US stock market showing bubble-like extremes in certain areas. That doesn't mean an immediate crash, but it does mean being careful about chasing momentum at current levels. The technology sector remains a mixed bag. While companies like Palantir are winning major contracts, there's growing voter concern about AI risks, with 57% believing risks outweigh benefits. That could impact sentiment around the OpenAI and Anthropic IPOs that are being discussed. The key is staying nimble, using stops, and not getting overexposed to any single theme in this environment.
Solid advice for navigating these crosscurrents. Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Let's start with what we saw earlier this week. On Tuesday, April 21st, we got the retail sales report, which is a high volatility indicator that measures consumer spending. The actual reading came in at 1.7%, which beat the forecast of 1.4% and was significantly higher than the previous reading of 0.7%. That's a strong signal that consumers are still spending despite all the economic uncertainty we've been discussing. It's worth noting that the previous release on April 1st showed actual of 0.6% against a forecast of 0.5% and a prior reading of 0.1%. So we've seen this consistent upward trend in consumer spending over the past few months. Now looking at what's coming up, Thursday, April 23rd, we'll get initial jobless claims, which is a medium volatility employment indicator. Then on Friday, April 24th, we have two consumer sentiment indicators releasing. We'll see the Consumer Confidence Index, where the forecast is 47.6 compared to the previous reading of 53.3, which would represent a notable decline in consumer confidence if that forecast holds. We're also getting the University of Michigan consumer sentiment on the same day, with the forecast also at 47.6 versus the previous 53.3. These sentiment indicators will be particularly important to watch given the strong retail sales we just saw, because there could be a disconnect between what consumers say they feel and what they're actually doing with their wallets.
That's an interesting potential disconnect between spending and sentiment. Now, Lizzie, let's turn to our stock of the day. What are you looking at?
Today, we're examining Xunlei Limited, ticker symbol XNET, which is a Chinese technology company that provides distributed cloud computing services, including cloud storage, acceleration services, and live streaming platforms. This is what I'd call a deep value situation that requires careful analysis. The company is trading at a current market cap of $412 million, which puts it in small cap territory. What immediately jumps out is the valuation metrics. We're looking at a PE ratio of 0.4 and a price-to-book ratio of 0.3, which means the stock is trading at just 30% of its book value. The company has a value score of 92 out of 100, making it statistically one of the cheapest stocks in the market. Now, before anyone gets too excited about those numbers, we need to understand why it's trading this cheaply. The company reported strong revenue growth in Q4 2025, driven by cloud computing and live streaming segments, and management highlighted sharp acceleration in overseas live streaming, which shows they're successfully diversifying geographically. However, and this is critical, despite that revenue growth, the company reported a significant net loss for the quarter. They've also just completed a strategic divestiture, disposing of their majority equity interest in Shenzhen Onthing back in March, which signals a potential shift in business focus.
So we have this massive discount to book value, but ongoing losses. What's your take on the risk-reward here?
That's exactly the right question. The technical picture shows an avoid bias with a negative 40 out of 100 entry score, which tells us momentum is poor despite the cheap valuation. The overall confidence level on this assessment is low, which is concerning. What we don't have, and this is a red flag, is any analyst coverage. The target price is not available, recommendations are not available, and we don't know how many analysts are following this stock. For a publicly traded company, that lack of Wall Street attention suggests either limited institutional interest or transparency issues. Now, the bull case would be that if management can turn those revenues into actual profits, even getting to a 5 or 10 times PE ratio, which would still be well below sector averages, you could see 10 to 25 times returns from these levels. The company has its next earnings report coming up on May 14th, which is 21 days away, and that will be critical. Recent news sentiment is actually very bullish with a score of 0.686, and the stock has been mentioned as an undiscovered gem in April. But here's what concerns me. This is a Chinese ADR which carries regulatory and potential delisting risks that we've seen play out with other Chinese companies. The corporate governance questions around Chinese technology companies and accounting practices add another layer of risk.
Given all those factors, how would you approach this as a potential investment?
I'd rate this as a speculative hold or avoid for most investors. This is only appropriate for someone with high risk tolerance who can afford a total loss, and even then, position sizing should be minimal, maybe 1 to 2% of a portfolio maximum. The combination of exceptional value metrics but significant losses, technical weakness, and structural risks creates a classic value trap scenario. It's statistically cheap, but there are legitimate reasons for that discount. For most investors, I'd say wait on the sidelines until we see several things happen. First, a clear path to profitability needs to emerge from that May 14th earnings report. Second, the technical momentum needs to improve and show some institutional buying interest. Third, we need more transparency and analyst coverage to develop, so we're not flying blind on expectations. And fourth, the broader Chinese ADR regulatory environment needs to stabilize. The upside potential is theoretically massive given the valuation, but the probability of realizing the upside versus losing your entire investment is unfavorable right now. If someone already owns this stock, I'd be watching that May earnings report very carefully and would have a predetermined exit strategy if profitability doesn't improve or if guidance disappoints.
That's a thorough breakdown of a complex situation. Let's shift to crypto markets. Lizzie, what are you seeing in digital assets for the week ahead?
The crypto market is showing some notable strength, particularly in Bitcoin. Let's start there because it's really driving the broader market sentiment. Bitcoin is testing the $78,000 resistance level, with the critical make-or-break zone being $79,200. What's interesting is we're seeing multiple bullish indicators converging. The Bitcoin bull score just hit a 6-month high, and the Bollinger Bands indicator is suggesting a powerful move is looming. BlackRock just added $900 million to their Bitcoin holdings, which shows institutional demand remains strong. We're also seeing Binance inflows fall to 2023 lows, which indicates reduced selling pressure. The Coinbase Premium just posted its longest bullish streak since October, when Bitcoin hit that record high of $126,000. There's even political tailwinds with the Trump ceasefire extension and a US admiral calling Bitcoin an instrument for US power projection in a Senate hearing. My outlook for Bitcoin next week is cautiously bullish. If we break above that 79,200 resistance level, I'd look for a move toward 80 to 84,000. The key support sits around 75 to 76,000. One interesting technical factor is that funding rates are actually negative at the 78,000 level, which suggests shorts are vulnerable to a squeeze if we get that breakout. The risk is if we reject at that 79,200 level, we could see a pullback to 75,000.
What about Ethereum and Solana? Are they participating in this rally?
Ethereum is showing strong independent strength, with analysis suggesting a potential surge to $3,000 soon. That's a significant psychological level and would represent solid upside from current levels. ETH is benefiting from the general altcoin rally momentum while also riding Bitcoin's coattails, but with some independent catalysts. The DeFi ecosystem continues to grow, and Layer 2 solutions like Arbitrum are gaining traction, though there was some controversy around Arbitrum's freeze function that David Schwartz defended by citing Bitcoin's 2010 rollback. My outlook for Ethereum next week is bullish, with that $3,000 level as the key target. The main risk is the heavy correlation with Bitcoin, so if BTC weakens, ETH will likely follow. Solana is also looking bullish with some unique ecosystem developments. BitGet Exchange is launching SpaceX pre-IPO tokens on the Solana blockchain, which is an innovative use case that's drawing attention. Solana continues to benefit from DeFi and NFT ecosystem expansion, and it's participating in the broader altcoin rally. The outlook is bullish for next week, though traders need to watch for network stability issues that have historically plagued Solana. Overall, the crypto market setup looks favorable for the week ahead, with Bitcoin's 79,200 level being the key catalyst that could unlock broader rallies across altcoins. Institutional flows remain supportive, and the technical setup suggests we could see that powerful move the Bollinger Bands are indicating.
Well, that wraps up another edition of The Morning Bell. We've covered a lot of ground today, from geopolitical tensions affecting markets to deep value opportunities and crypto momentum. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the podcast so you don't miss our daily market insights. I'm Robert, thanks to Lizzie and Steve, and we'll see you tomorrow morning.